So this is our last video. We're on 7.3 financial statements, and if you want to follow along with me, it's on page 562, and we will have a little bit of flipping to do back and forth. So we're almost done, you guys. We are just needing now to do our final step, which is making our financial statements. We're going to talk about it in two different categories. The first one is merchandise business using a periodic inventory system. When the worksheet has been completed, financial statements are prepared, just like they were in Accounting 10. These include the schedule of cost of goods sold, the income statement, and the balance sheet. So those are the things that we're going to learn how to do. The financial statements may also include a separate statement of the owner's equity. If such a statement is used, the complete equity calculation is not included in the owner's equity section of the balance sheet. And if you look at if you want to look back in the textbook to what we covered in Accounting 10, it's on page 180. Preparing the schedule of cost of goods sold. The first statement prepared is the schedule of cost of goods sold. The cost information to prepare this schedule is in the income statement section of the worksheet. Rapallo Enterprises uses merchandising inventory, a beginning and an ending inventory, and purchases. Other cost accounts in the schedule of cost of goods sold can be the transportation on purchases, purchases returns and allowances, and purchases discounts. So here is this company's schedule of cost of goods sold. The merchandising inventory was $90,000 at the beginning. They purchased $110,000 worth of merchandise for a total of $200,000. At the end of the year, they had $86,000. So the cost of the goods sold is $114,000. Now that the cost of goods sold figure has been determined from the schedule of cost of goods sold, the income statement can be prepared. This, I don't know if I have it here, indicates that the cost of goods sold during the year was $114,000. This figure is now used on the income statement, which is on figure 1112, and this is the one I'm not sure if I have. It's on page 564 of the textbook. We'll see if I included it here. So if you're looking in your textbook, these are the things that you're going to see. The grouping of accounts using a standardized format is an aid to those who examine and interpret financial statements. Owners, managers, creditors, and government officials examine the financial statements of a variety of companies. Their task is made easier by the use of a standard classified financial statement. Both international financial reporting standards and the Canadian accounting standards uses the same items. The income statement on the next page, which is 564, is a classified statement. There are three main sections. There is the revenue, the cost of goods sold, and the operating expenses. In some instances, two separate categories might be found in the expense section called administrative expenses and selling expenses. And you'll see that that's what's listed on page 564. Administrative, oh, I think I do have it here. So you'll see those sections there, and they do use administrative and selling expenses, and I'm going to explain that to you. Administrative expenses is money spent in the general operation of a business, is usually classified as an administrative expense. This would include expenses involved in the operation of the business, office, and all departments other than sales. Office salaries, office supplies, and building maintenance are just a few examples. There's also selling expenses. Money spent for the direct purpose of selling goods is classified as a selling expense. Some examples include salesperson salaries, advertising, deliveries, and sales supplies. Classifying expenses as administrative or selling expenses provides a detailed breakdown of where the money is being spent. It also allows the top management of a company to allocate responsibility for the spending of the money. For example, if the sales manager is held responsible for all selling expenses, it is the responsibility of the sales manager to justify the money spent for all of the selling expenses. Responsibility for administrative expenses may be allocated in the same manner. An office manager may be held responsible for controlling the administrative expenses. Some costs may be allocated as both selling and administrative expenses. For example, insurance expense may be incurred on behalf of both the office and the sales department. Depreciation may have to be divided between the administrative and the sales sections. It is the accountant's task to determine a fair basis for allocating the expenses. For example, if the management office occupies 30% of the building, then 30% of the depreciation on the building would be charged as an administrative expense. If the sales section occupies the remaining 70%, then 70% of the depreciation on the building would be charged as a selling expense. The next statement we need to make is the balance sheet. Another name for a balance sheet is a statement of financial position. The data required for a balance sheet are found in the balance sheet section on the worksheet. So that's where you're going to get your information from. And if you look on page 566, the balance sheet is there for you. Notice how capital is updated in the equity section. The additional investments and the difference between the net income and the drawings are added to the capital account, because things are changing, right? So the capital you start with is not the capital that you're going to end in with, because you have a net income and you have some drawings that need to go there. The balance sheet is also a classified statement, as we've said previously. It is much easier for users to examine and interpret such standards or classified financial statements. And we learned that back in grade 10, that your assets are divided between current assets that you'll be collecting soon, and fixed assets that are long lasting. And same thing with your current liabilities and your long-term liabilities. Okay, so you can look at the balance sheet on there for you. We need to talk about the adjusting entries. Adjusting entries are required so that adjustments made on the worksheet become part of the permanent records. Remember, a worksheet is just for your own purpose. It's to prepare the work. Now we need the adjustments. And when you've labeled them A, B, C, it is easy for you to go back and have a look at them. And I think I've got them here. So these are the ones we talked about in the last section, and they are just recorded the way that we had talked about them. So you can go through that on your own. We also need to have some closing entries. They're required to prepare the ledger for the next fiscal period and to update the owner's capital account. The revenue, the expenses, the cost of goods sold accounts are closed in an income summary. So they're transferred to the income summary just like they were in grade 10. The income summary and drawings accounts are closed into the capital account. The four basic closing entries look like this. And they're on the next page. I'll flip that in a second. You need to close the credits from the income section of the worksheet into the income statement account. You need to close the debits from the income section of the worksheet into the income summary account. Then you need to close the income summary account into the capital account. And then you need to close the drawing account into the capital account, exactly like they were in grade 10. So your closing entries would look like this, and you've got your four sections right here. And exactly the same thing is followed every single time, but of course, depending on which worksheet you're working with, the values will change. The last thing you're going to have to do is you're going to have to post everything that you've just done in the adjusting and closing entries into the ledger. And so you would have to go through here and your ledgers would look like this. Okay, and it shows why you're doing what you're closing, what you're transferring, and here's some more here as well. Okay, notice that now some of these have zero balances, which is what you were wanting to do. You're getting them ready for the next financial period. Okay, there's also another way to close entries for the merchandising inventory. The closing entries for A. Rapallo Enterprises uses the alternative method of adjusting merchandising inventory. If you look at figure 1117, I'm just going to flip to that page. It is on page 571. Okay, so this is what has already been made. The general journal on for figure 11.7 contains the closing entries prepared for the worksheet from 550, which is what we used in the last section. Can you trace each entry back to the worksheet? Note that no entries are made to merchandising inventory. This account was updated through the adjusting entries shown above. Both methods of recording inventory are acceptable and result in the same information being generated in the firm. However, the first method described had two advantages. Fewer journal entries were required, and the entries to income summary are obtained directly from the income statement columns totals in the worksheet. As mentioned previously, the first method is used in this text unless the alternative method is specified. Okay, so we're going to go with the first method. Okay, there's the set there. And then the very last thing that you have to do at the end of the accounting cycle is you need to make a post-closing trial balance. This is found on page 572 of your textbook, and it tells you everything that you need to know, and everything you've done is balanced, so you should be good. Okay, the last thing we have to talk about is examining some reversing entries. Now this is a little complicated, and you just have this to go back to if you need it. Earlier, you learned how to adjust accrued expenses. The example used was $225 in interest and was owed on a bank loan. The loan was for 6 months. At the end of the fiscal period, 3 months worth of interest, $225 was owed, but had not been recorded because it was not due to be paid until March 31st. The following T accounts illustrate the adjusting and closing entries. So we have our adjusting entry here, our closing entry here, and our adjusting entry here. On March 31st, payment was made to the bank for 6 months, interest of $450. This covered the full period of the loan, October to March. When this entry was made, interest expense was debited $450 and cash was credited $450. But there's a dilemma. Can you see it? How much interest on this loan had already been recorded in December? Because of the adjusting entry, the interest for October 1st to December 31st was recorded twice at $225. Once when the adjustment was made, and again when the interest was actually paid to the bank. A total of $675 has been recorded to the interest expense account. The actual amount of the interest is only $450. This double recording of interest is avoided by the use of a reversing entry. In general, reversing entries are used to make adjustments to accrued revenue and accrued expenses. So those are the only times we'll be doing these reversing entries. On January 3rd, the first working day after the end of the fiscal period, the reversing entry is made. We need to go back to accounts payable with a debit, and we need to credit our interest expense to bring it down by the amount that was double recorded. The effect of this entry is shown here. Okay. So you have your adjusting entry of 225, you closed it here. You made a payment of 450, but then we want to go and take out that 225. So our interest payable now for December and January, and the cash that came out was 450. Notice that the reversing entry of January 3rd has the effect of allocating half of the actual interest paid to the new fiscal period and half to the previous fiscal period. This is correct and results in the correct matching of expenses and revenue for each fiscal period. Reversing entries are required for all accrued expenses and accrued revenue adjustments. Earlier in this chapter, an adjusting entry for salaries, which were owed of $1,200, was explained. The adjusting entry is shown in the T accounts. You had your expense debited $1,200 and your salaries payable $1,200. This entry is necessary because sales commissions are paid in the month after they are earned. The closing entries result in the following: in the T account to salaries expense. The reversing entry shown below is made on January 3rd. This entry is necessary to avoid a double recording of the sales commission. The accounts now appear as follows. On January 31st, the sales commissions are paid and the following entry is made in your general journal here. The accounts are shown here. Similar reversing entries are prepared on the first working day of the new fiscal period for all accrued expenses and revenue adjustments. Reversing entries could be avoided by debiting the payable account when payment is made in the new fiscal period. However, this is not done. With a number of accruals and payments spread out over the month, it would be easy to forget to handle the transactions correctly. To avoid errors and reliance on one person's memory, it is standard accounting practice to use the reversing entries. Okay, now we'll go through this quickly. The same thing can be done using the perpetual inventory system. The accounting cycle for merchandising a business that uses a perpetual inventory system follows the same procedures, but there are some differences. A completed worksheet for new enterprise store, a merchandising business that uses a perpetual inventory system, is on page 557. And we're almost done, guys. Just hang in there with me. The perpetual system differs from the periodic system in two ways. The cost of goods sold is recorded as sales are made and is found in the cost of goods sold account on the worksheet. The calculation of the cost of goods sold on the worksheet or on a separate schedule or on the income statement is not required. The merchandising inventory account on the trial balance is accurate since it has been updated continually. There is no need to adjust the value of the end of the accounting period. Any difference between the physical inventory and the ledger balance has already been adjusted. The continuous availability of these two pieces of information enables merchandising firms to generate accurate financial statements during the accounting period as well as at the end. This is called interim financial statements. They are financial statements prepared for periods of time, for example, at the end of the month, the quarter, and so forth. The first statement prepared by New Enterprise Store from the worksheet is the income statement listed here. The classified income statement and balance sheet would be prepared using the data from the worksheet in exactly the same way as you prepared the statements for a business using the periodic. The adjusting and closing entries for a merchandising firm that use a perpetual inventorying system are prepared from the worksheet in exactly the same manner as the periodic inventory. And that is it. You have followed everything that you need to know. The accounting cycle we have followed from the beginning right away through to the end. So you've done it all.